Do you want to know how I normally come up with the best possible offer on a business purchase? One offer that makes you not only competitive as a purchaser, as a buyer, but one that gives you the best cash flow per month? We'll do that and more using a tool that I call the Deal Analyzer. Let's get to it. Hey everybody, welcome to my channel. I am your host, Leo Landaverde, business broker and commercial lender, helping you buy or sell a profitable business. You are a small business owner looking to scale your business by buying a profitable business, or if you are in the rat race as a W-2 employee looking to buy a profitable business as a way out, then this channel is for you. I would encourage you to subscribe to my channel. Don't forget to hit the bell. You'll be notified every Thursday when a new video comes out.
All right, guys. So let's get into it. So this is what it looks like. So from this section here, what you're looking at on the left, it's the deals, the deal points as they come listed from the broker, either a biz, buy, sell, or whatever else. In the offer memorandum for the deal, this is what comes up. So I have put them to the left, and on the right is going to be our analysis. Right here, this is our analysis, and to the left is what is given to us by the broker. So I haven't changed anything. So we get an asking price of $1,235,800 on this particular deal. This is a service business that doesn't really have a lot of inventory, but I have some references here to help you guys, some questions to ask. Whenever you're looking at the asking price, is inventory included in price? If not, what is the aggregate value of all inventory? Will there be any excess inventory? If so, how much will it be? Any excess working capital included? So typically in an asset sale, you get to keep the excess working capital, the difference between normal working capital and excess you get to keep. So questions that we're going to have. So right now we're just doing our early preliminary evaluation of this deal. 1,235,000 sales or revenue, most recent revenue, current fiscal, from as we end 2022, estimated revenue 2.1 million, cash flow or selling discretionary earnings of 247,160. That's a very exact number. So it must be backed up by good evidence. And, I can tell, but when I'm evaluating deals, the broker that I'm dealing with, the listing broker, the one representing the seller, where they've done their job. I mean, when you have kind of round numbers, sometimes it kind of makes me think that this is just very approximate, but this is kind of very exact. So it tells me that there is a pretty good indicator that they have a lot of source documents that are going to back this claim. So what this results here, by the way, you only enter data in the blue columns. Everything else is formulas. So these formulas are currently unlocked. If I ever share this latest version of my cash flow, this deal analyzer, which has a lot of different sheets that are interrelated, then I'm going to have to lock it. But look, I mean, there's analysis that goes in, and as far as how to how we look at the loan, and a bunch of other things. We don't have the time to get into. We're just looking at the deal, analyzing whether this is a buy or no buy, or go or no go. So 5 times seller discretionary earnings. Now, per the listing, per the information given to us by the broker, they want the buyer, to put out the 20%. So that means that the difference, it's going to be on a bank loan. They are not saying, the broker is not saying the seller will carry any, but if it did, it would be here. It would have listed it. So let me give you an example. So if the broker would have said that the seller was willing to carry 10% seller financing, that would have mean that our loan would have been on 70% and 20% from you, and all these formulas. Okay. But that's not what they're saying. They're saying that 20% down. So this is a very important number. This is your debt service coverage ratio to the left, which means that a bank, as I'm looking at all these deals, they all have to, most of my buyers are going to be getting a loan. most likely an SBA loan, a 7A loan, whether it's fixed or variable, to buy this business. And they're going to be coming up with somewhere between 5 and 20% down. The average is 10. 1.61 is a pretty good debt service coverage ratio. So I know that even with the information that is given to us by the seller, that this is a deal, at least on paper, that looks good. Okay. What this is our annual cash flow after debt service, 93,647, based on the information that we have. That this assumes that you're going to be working in the business, that you don't have a manager, that you're going to be involved yourself in running the business. If you're going to need a manager to run the business, you were looking to run it as an absentee owner, which I don't recommend. If this is your first business that you're buying, you need to really get some experience under your belt as a working CEO, especially if you're coming from corporate America into business ownership. You really need to really get into the role of the CEO and really running this business before you decide to hire a manager, a general manager. Cash on cash return, 37.9% on a cap rate of 20%. Those are pretty fantastic numbers if you're coming from the real estate investing world. You'd be lucky to get anywhere from 4 to 6%. 4 to 6% cap rate and cash on cash return, more than 20%. What this information is going to be your own research as to how many, there are places where you can learn how to get industry averages on seller discretionary earning multiples and EBITDA multiples. Now, the difference between EBITDA and SDE is that on EBITDA, we're going to have a working CEO or a general manager or president or operations manager, whatever you want to call it, that is going to be assumed under the operating expense, which means it's going to be a cost that we have to factor into from the SDE. So that's why your multiple is going to be a little higher at EBITDA. There's going to be on SDE. And I have left it at 5 times EBITDA so we can match on either side. So you can know that right now we're pretty much tying. If I was to make this number 10%, the difference between the two scenarios is 0. So it takes some familiarity how to work this thing. There's other things I want to show you. As I said, the parts in blue are input. Everything else is a formula. This is where you really want to be looking at. This is really best case scenario, and you'll see that in a little bit. Usually, if there's going to be any seller financing, if there is a bank involved in the SBA loan, they will want the interest rate from the seller to be lower than the interest rate that is coming from the SBA loan, and they want the seller is going to have to subordinate to the SBA lender. They're going to be in second position. So that's why a lot of sellers don't like to do seller financing. And if they do seller financing, there's going to be for anywhere from 5 to 10%. Sometimes I've seen it, they do 15%. It really depends on the deal. Every deal is different. So we're just looking at this deal right now to see if it makes sense, if I'm representing the buyer, if this is going to make sense for us, if this is assuming that this is a good business that has good operational, good history, good everything, good unique selling proposition, etc. So we're purely just looking at the numbers right now. Amortization rate terms for the seller, if there's going to be SBA lending involved, they will want the amortization from the seller note to mirror the amortization on an SBA 7A loan, which is normally 10 years if there's no real estate involved. If there's real estate involved, the real estate piece is going to be a separate transaction, but what it's going to do is going to allow for the two loans to be amortized, and the blended amortization period is going to be longer, which is actually good for you because it's lesser payments per month with no prepayment penalty. All right, so now that I show you that, there's one little tidbit I want to show you on the use of proceeds, which is purely, this is the lending side of things. This is where we did, so this is where the information about the loan goes. There's a lot of formulas here. Again, we only put in the information that pertains to us. This is going to be a 7A loan right here. There's going to be guarantees. I don't want to worry too much right now. I don't want you to worry on the rest. That's a lesson for another day as to how to calculate all this stuff. But suffice to say that this sheet and this kind of work together. They populate each other.
Do you need help with the purchase of a business or the sale of a business? I would love to help you. All you need to do is drop me a comment below or email me directly. My email address is in the description section of this video. Let's connect and do business.
So the only thing that we needed to worry about is the amount of the purchase, which comes from here. The business acquisition is connected to the deal analysis, and everything else is kind of calculated that way. Okay, so back to this. All right, so we do not want to put 20% down because it affects. So we want to go on a 10% down situation. Okay, so in a situation like this, now this is when I start looking at pound for pound. If the industry average is 3 to 5 times seller discretionary earnings, and this business is not too big to have an operational manager, this is definitely low on the lower middle market section. So we're gonna say that it's a little on the high end. I don't know why the seller would want 5 times SDE for a business that is doing 2 million. So we're gonna start chipping away. But if it was only if we're only offering four times SDE, now our asking price is gonna go from 1,235 to 988,000. Everything else is the same. Our down payment went down to 98,000, right? And our loan goes to 889. Our debt service coverage ratio went from already a pretty good debt service coverage ratio to really good at 1.79, which means you have 80% more cash flow than you over the debt service, which is it gives you breathing room. Notice that your annual cash flow post debt service went from 93 to 108, and your cash on cash return went from 37 because you were putting 20% down to 110% because you're putting $98,000 down. So you are recouping in your first year over the amount of money that you put as a down payment. You see how this is kind of start to make sense? The lower the SDE on the offer, the more cash flow at the end of the year. As you notice now, what happens at 3? 143. What happens at 2? So the reality is that the reason why I like businesses that are represented by brokers is because the broker did a really good job on helping the business owner have a good idea what a business should be selling for. Now, most business owners that I deal with, if I'm going to represent them, they have this over-the-top inflated idea how much the business is worth, not really understanding all the moving parts. And just like when you own a house, you always think your house is a lot higher than it really is, that your house is worth a whole lot more than it really is. So is with a business. A lot of business owners think that the business is worth a whole lot more than it really is. If this is an asset purchase, what you're buying is the assets. Oh, by the way, other than the excess inventory or the excess working capital, the assets that you're buying to operate the business are included in the multiple. So back to, I don't think 2 is reasonable. They're going to laugh your way. Now, remember what I said at the beginning of this video, that you want to come up with an offer that makes you competitive. We don't know how many offers this broker, the listing broker, is dealing with, the listing agent. If you lowball this offer, you're probably not ever going to hear back. So you have to be respectful that you have to do something that is good for you, that give you the highest cash flow per month and per year, but without being offensive, unless you really don't really care about the business and you're just looking to be a bottom feeder. So I think that somewhere in the neighborhood or 3.5 times to 4, given what I know about this business, it's going to be a reasonable offer. The seller is going to get a lot less than what they thought they were going to get, and they can make counter. Now, what I tell sellers that sometimes it's best to carry a note, to do some financing to help on the bank loan if there is needed. So maybe it says, you know what, carry 10% rather than have the down payment be 20 for the buyer. You carry a note that is going to be subordinate, and the downside to the seller is that when you are carrying paper, when you're seller financing, the the SBA lender may actually put a moratorium in how you get paid, and you may have to wait a couple of years, given on the performance of the loan and the business, for you to get paid. That's a drawback for a seller to carry a note. But this is already formulas. So the $17,000 per year is based on a formula at 7% over 10 years. $17,000, 218 is your annual debt service for the seller note, and 153,000 per year is the principal and interest payments. So even with that, if you notice in the formula, we have enough cash flow to cover the debt. It gives us 76,000. Even at this scenario of 145, I'm very comfortable in saying that an SBA lender would look at that and be financed by an SBA lender. So this is a financeable deal as it is. Now, it would be even better if you can get it lower than the 5 times multiple of SDE. Businesses that are north of 5 million and higher than $500,000 in worth of EBITDA will probably trade for EBITDA multiples, which means that these are professional operators, whether they're private equity groups or strategic buyers that are going to bring a management in. They're going to factor in a president or a branch manager or a general manager who's going to run it. So they already accounting for. They don't mind adding the expense, but they're going to be absentee owners, or they're going to be kind of a little more removed from it. Now, what we have on this side is something that you should look. A lot of these deal packages from the confidential information memorandum with the CIM or the offering memorandum, either way, that they don't tell you sometimes percentages. To me, percentages are even more important than dollars. So what 247,160 means is that it is 11.8% net income. So the seller discretionary earnings as a percentage, look at the formula, as a percentage of the revenue, it's going to be 11.8. Maybe this revenue is, I don't know whether this revenue is the average of the last 3 years, discounting 2020, the COVID year. I don't know whether this is yet still the projected year-end revenue for this year, or is this the average of the last 3 years? We don't know. We don't know enough yet. I'm just doing a very preliminary take at this. 11.8 is not bad. I would like it higher. What would happen if you grew the revenue, if you bought it at 2.1 million? And of course, I hope that you're in the market to buy a business, not to keep it flat. You want to buy a business so you can grow it, so you can have more cash flow, and because there's no prepayment penalties on the loan, you can actually pay the loan faster and have more cash flow at the end of every month and every year. So I believe that 11.8, including the seller, including all the add backs from the owner, I think this business could be doing better. We don't know enough as to why his SDE as a percentage of revenue is 11.8 when it should be higher. But what if you actually manage to get the net profit at 15%, and that's just the net profit, that doesn't include add backs? Look at the seller discretionary earnings. If you bought this business and you turn it around and you really added either the marketing fuel or your savvy and turn it into a profit, a cash cow, then you have $375,000 worth of seller discretionary earnings and $254,000 post debt service cash flow. That's $20,000 a month. I would say, based on what we have, guys, this is a pretty good deal. I would say this is a go for us to go into a letter of intent mode, so we can actually get this deal with a closer look, takes it off the market, gives us a chance to actually look at this deal closer. A letter of intent is a non-binding instrument, but allows us to get a closer look so we can get into due diligence. Notice some of my comments here, that we need to fully test the net income assumptions during due diligence, and that goes for everything else. Tax returns, interim financials, whether cash and accrual. Sometimes I like to see both cash and accrual, internally generated financials in the interim for this year. And so we can dive deeper, either validate that this is really a good offer, or even can become even a better offer. So I hope that this helps, guys. This is kind of a cursory review at everything, but this is kind of what I do on a weekly basis. It gets exciting to know when you have a deal that could actually be a windfall for you. So if you need help buying a business, come to me. Thank you for letting me share.
Limited time, I'm giving away my cash flow calculator, the very tool we use today to analyze deals. All you have to do is click on the link below and you can have the workbook and you can email me with any questions. I'm here to help you. Thank you very much.